Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for giving us a few minutes of your time to learn about what investors are focusing on right now and how that fits in with your portfolio construction and asset allocation. Now, on September 24th, the People's Bank of China, the Chinese securities regulator CSRC, and also the financial regulator NFRA announced a series of policies to support the economy. In the past 2 years, investors have been anticipating more support to the real estate sector and also the broader economy, but frankly, policy support has fallen short of expectations so far. So I want to take a look at the latest announcement and see if this is something that could help to bring some optimism back to the Chinese markets. So let's just walk through the policies. To start, the reserve requirement ratio is reduced by 50 basis points, which will inject around 1 trillion yuan into the economy. Top 6 banks will also receive more Tier 1 capital to their balance sheets. The central bank governor Pan also mentioned that further cuts in RRR are possible. At the same time, the 7-day repo rate will be reduced to 1.5% from 1.7%. In the real estate sector, outstanding mortgage rates are also reduced by an average of 50 basis points. This would save mortgage borrowers around 190 billion yuan a year. Second home buyers' down payment is also reduced to 15% from 25%, in line with the first homes. Brokerages could also tap central bank to buy stocks by setting up swap facilities that is worth 5 billion yuan, and this could be stepped up if needed. The central bank is also looking into setting up specialized refinancing facilities for listed companies and major shareholders to buy back their shares. The authorities are also looking into set up a stabilization fund. Now, even though in isolation some of these policies have been seen before, I think what's special about today's announcement is the coordinated approach. This reflects a renewed sense of urgency by Beijing to boost the economy. Recent economic data continues to point towards slow recovery momentum, and policy support in the recent past have fallen short of expectations. The risk of delaying stimulus is that more aggressive policy will be needed in the future if the economy is allowed to be stuck in a low gear. We often call this hysteresis in economics, where downturn gathers momentum and turns into a vicious cycle of decline. So there's a need for the authorities to intervene earlier so that the stimulus would be more manageable. Now, will these policies work? Now, these are no panacea or magic bullets, but I do think that these are steps in the right direction. As mentioned above, the sense of urgency shown by the coordinated approach could finally convince investors that more policy support is on its way. The real estate sector correction could need more time, given the inventory overhang and the cautious price expectation by potential buyers. But lower mortgage rates will help to give households a bit more money to spend, and lower down payment requirements would help potential buyers to buy a house as long as they expect property prices to be rising. On reserve requirement reduction and policy rates, China has been steadily cutting these in the past few years, but extra liquidity has not really translated into faster lending growth. We've long argued that banks need to feel more comfortable about the default risk being manageable, and also on the demand side, the lack of demand for housing means mortgage growth is likely to be slow if not negative, and the same goes for corporate borrowing if corporate sentiment continues to be cautious. Hence, liquidity injection and rate cuts are part of the condition to boost lending. The key to maximize the benefit and impact of these policies will be to boost the confidence of household sector and also the corporate sector. Today's announcement is an important step in reaching this goal. Now, the immediate market reaction has been more positive for the offshore market, i.e. Hong Kong, than the onshore market. It's worth noting that the H-share market in Hong Kong has been trading at a significant discount relative to the onshore A-share market for quite some time. Alongside with a potential boost from the Federal Reserve cutting rates, international investors may opt for the offshore market first ahead of the onshore market. Although this is not a definitive bullish signal for the Chinese stock market, we see this coordinated policy approach could pave the way for more policy support to come and could raise the possibility of an economic upcycle in 2025. Combined with private sector companies that have improved their profit margin and corporate fundamentals, we do see some value opportunities in Chinese equities and as a way to diversify from more expensive markets around the world. Thanks for listening. If you have any additional questions, feel free to reach out your JP Morgan Asset Management client advisors, and also please subscribe and share with your friends and colleagues if you find this podcast useful. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.